Hello, this is Josh Belk with Belk on Business Podcast. Today, we're going to talk a little bit about the Augusta Rule. It's one area that I've been pressed to kind of record a standalone podcast on this particular topic, and I know that it's one that I'm not on the social media platforms, but I would say this is probably the one area that is, from at least what I've been told, is one that's talked a lot about as far as little snippets, as far as people who talk about, great tax saving strategy to use this particular rule. The one part, the biggest issue with all of this is, number one, usually a lot of the information that's put out there, at least from what has been shared with me, is incorrect or partially incorrect or even mostly incorrect as it relates to, well, first of all, it is correct indeed that it is a tax reduction strategy, and it is a legitimate one. But what is not told is in regards to who can use it and then ultimately the process. So a lot of people think, well, I'll just go, when I go to prep my taxes, I'll just kind of look back and I'll kind of determine, I'll take, 14 days times, some sort of a rental value, and I'll just write it off as rent expense. Well, the problem with that is that there's a lot of steps that go into place in regards to making sure that this rule is utilized correctly. So the Augusta Rule, let me kind of do a little bit of more of a proper intro for those of you who may not know what this ultimately is. I'll talk about it a little bit. So the Augusta Rule, for those of you who follow sports at all, familiar maybe with the Masters, is probably the biggest golf tournament, one of the biggest golf tournaments every year, a PGA tournament. And it's held in Augusta, Georgia, and so where the Masters tournament is held. And so this particular rule is called the Augusta Rule because the local homeowners in that particular area, essentially this rule allowed for them to rent their house, their primary residence, their personal residence, up to the 14 days a year and be able to exclude that rental income from their income taxes. Now, so this rule was codified as part of IRS Section 280A. So if you're ever dealing with the IRS, that's what it's referred to as, IRS Section 280. What is this deduction? So the Augusta Rule, essentially, or the IRS Section 280A, allows for homeowners to rent out their primary residence as a vacation or short-term rental. And what it has now been essentially expanded to also include renting to your own business for up to 14 days per year without needing to pay tax on the rent collected. So what I'm going to do here, there are some compliance pieces that you have to walk through. Okay, that you have to make sure that you are complying by in order to be able to utilize this rule. It is a wonderful strategy. If it's used properly, it is one that can save you some tax dollars. And the amount of tax dollars is going to vary by situation, and I'll talk a little bit about this as we talk through this. So what are those compliance components? So first of all, so it is 14 days or under. At the point that you hit day number 15, the entire amount of rent collected becomes taxable. And of course, you can write off direct expenses as it relates to that rental income. But just kind of understand that it can only be 14 days or under to ultimately use this rule as far as the exclusion as rental income. So that's number one. So first of all, it has to be 14 days or under. Secondly, the rental amount must be reasonable. Okay, so you kind of have to take a look at, if we're talking about now, this rule originally was primarily for what's now called a vacation or a short-term rental. So if you kind of look in the community, if you're going to rent your home out to a third party as a vacation or a short-term rental, what is that dollar amount? Now, I'm going to really kind of gear this podcast toward the clients that we serve at the firm that I own, and for the most part, those that listen to this particular podcast, and that's business owners. So if you are an individual that happens to be listening to this, and you don't have a business, this rule can still apply to you if indeed you do rent out your home for up to the 14 days a year. So if you're just, if you have an individual, you don't have a business, or maybe you do have a business that wouldn't qualify, and you do some traveling, whatever the case may be, and you decide to rent your home out, you can do that up to 14 days a year. And essentially you can overall just exclude the income from your income taxes. So as I talk through the rest of this, primarily it's going to be for those who have a business and then want to rent their home to their business for up to the 14 days a year, or to another business for up to the 14 days per year. So first of all, it must be 14 days or under. Secondly, the rental amount must be reasonable. So if you're kind of looking in the area, what does it cost to rent out the house in the area? And, say that normal, per night rental amount is $300 a night. You cannot charge your business $10,000 a night. You can't even charge your business $1,000 a night. That is not fair market value or fair rental amount for your home. So first of all, as it relates to the amount, that it must be reasonable. So it must be a fair market value or fair rental value for that home. And so you can go about doing this if you look at other, if you go to, and there's plenty of avenues out there, Airbnb, Vrbo, et cetera, even some privatized types of platforms out there that you can kind of take a look and see what does a home in my area rent for, and find similar property or properties in the area, and you can use that as your baseline. Next, your home cannot be your primary place of business. And so this is one area, once again, that usually doesn't get discussed, and a lot of people think they can use this, and they say, okay, well, I have a home office, okay, and I want to go ahead and rent my home to myself for the 14 days a year. That is excluded. So you cannot, so it has to be, essentially, your home cannot be your primary place of business. So it can't be, if you have a home office, whatever the case may be, that will exclude you from being able to use the Augusta Rule. So if you have a business or businesses like mine where we have physical locations, and if I were want to rent out my primary residence for up to the 14 days a year, is great. I may have an area in my house that I do work in, and most of us who are business owners do. Many times we are taking our work home with us and we're working there, but I'm not writing off a home office deduction. Okay, so the home office deduction generally isn't allowed for businesses that are taxed as corporations and partnerships anyway. But if your home is your primary place of business, you cannot use the Augusta Rule. Okay, so the next point. So number one, 14 days or under. Number two, the rental amount must be reasonable, fair market value, fair rental value for that property. Next, your home cannot be your primary place of business. Next, number four, if renting to your business must have the right structure. So if you are a sole proprietor or you're a single member LLC and you recognize your income and expenses on a Schedule C on your individual income tax return, you will not be able to use this particular rule. Okay, so it must be in a situation to where you have the right structure. So your LLC is taxed as a partnership or taxed as a corporation, or you have a partnership or a corporation. So if you have, so think of it in this way: if you have an entity that has its own place, its own location, and then it is taxed as a partnership or as a corporation, S or C, it doesn't matter, you can use this rule. So if you are renting to your business, it must be and it must have the right structure. Next, number five, there must be a true business purpose for the rental. So you just simply can't just go back and say, okay, well, I'm just going to say that I rented my house for the 14 days, and I'll use a fair market amount. I qualify otherwise. It has its own separate tax return, the whole amount. I'm going to figure out what that is, and I'm just going to write it off as a business expense. Okay, so there must be a business purpose. So this is something that's actually planned beforehand, and then the execution, the compliance needs to happen in real time, and then in regard to some of the execution on the other side of it, and I'll talk about that here in a moment, must be completed as well. So there must be a true business purpose for the rental. Now, some people think of, as far as business meetings or planning or strategy sessions, those are good. Maybe you use your home. So say you're in real estate, for example, or you have a business and maybe you have a photo shoot done in your room or in your house. Come in and they use it for recordings. Maybe you have a studio and you do some recordings. And I've done podcast recordings, for example, at my primary residence, and so those types of scenarios. So there must be a business purpose for it. And so it's something generally that is planned ahead of time, and so there must be a true business purpose for that, for the use of your home for your business for those days. So you think of planning, strategy sessions, recording, marketing purposes, masterminds, etc. Next, number six, you must have the proper substantiation of the business relationship, which would include some of the following. Generally, there should be some sort of a contract. So if you're thinking, if you are renting your home to a third party, what would you have in place? So remember, your business should be operating in a way, and this is a kind of a baseline where we talk about for asset protection, for tax purposes, also for this, okay, be thinking that your business is a separate entity. So if you were renting your home to a complete unrelated third party, somebody you've never met before, some stranger on the street, some business owner in a faraway state that happens to be coming in, what are some elements that you would put into place? You would, first of all, you'd have a rental contract. Okay, so there should be something in writing between you and your business that essentially contractually states the agreement between the two parties. And generally, there would be an invoice remitted. So you individually remit an invoice to the business for the amount of the rent for the day or days that their home is being used. If it is for your business, you're going to have meeting minutes. So if you are conducting indeed planning or strategy sessions or your annual meetings or quarterly meetings inside of your home, you're going to want to make sure that is documented via meeting minutes. If you're using it for marketing purposes, recording purposes, okay, you're going to have the photos, you're going to keep videos, and those types of substantiation, things that you would put into place for substantiation of any other type of an expense inside of your business. So photos are helpful. If you send out invitations, think about if you are having some sort of a mastermind or a meeting or something in effect, normally you send out invitations, some sort of a notice of the meetings. That would be included as well. Of course, the agenda of the meetings, emails, etc. So any of those documents that you would have normally in place, if your business was going someplace else to and holding a meeting, what would you send to those mastermind members? What would you send to your team internally? And so all of that should be there, as well as the rental contract and the invoice between you and the business. Next, number 7, a 1099 miscellaneous must be issued to you personally from the business if the rents exceed $600 a year. Now, there's a lot of information out there on both sides of this. Okay, some people say, oh, you don't need to do it. You just simply exclude it. Okay, now that can be the case if you're under an accountable plan, which I'll talk about here in just a moment. Okay, but generally, if you are renting your home to your business and that rent amount over the course of the calendar year is over $600, you need to issue a 1099 from the business to you for that amount. And then you will properly footnote on the tax return in regards to the exclusion of the income, or essentially the offset. And so, and there is a way of doing this. Your tax professional, if they know what they're doing, is going to know how to walk you through this process. Okay, so make sure that a 1099 is issued. That being said, 1099s are, here I am recording this in the middle of November of 2024. The 1099s for the 2024 season need to go out by January 31st of 2025. So here you are next February deciding that you want to go ahead and use the Augusta Rule. Well, first of all, you didn't actually have the meetings, or maybe you did and you have the other documentation, but now you passed the 1099 deadline. So make sure that all of this is done properly and in the right timeline, just like every other aspect of your business. So if you do rent your home personally from you to your business for whatever purpose, to make sure that your business issues you a 1099 MISC, 1099 miscellaneous, for the rent amount. Okay, so a 1099 must be issued. And then next, number 8, in regard to the accountable plan. So if this rule can also apply to employees or shareholders of a corporation if covered under an accountable plan. So this can be a situation to even possibly some of your, if you have other shareholders or employees inside of your business, can under an accountable plan also be able to use this. And what they'll do is they'll hand in the substantiation to the business, and the business will essentially reimburse the employee under the accountable plan, and that can work around some of the 1099 rules. Okay, so once again, let me kind of run through the rules, what is required to be able to use this Augusta Rule. First of all, it must be 14 days or under. Secondly, the rental amount must be reasonable, fair market value, fair rental amount. Thirdly, your home cannot be your primary place of business. Next, number 4, if renting to your business must have the right structure in place. Okay, so it must be an entity taxed as a partnership or a corporation, or it is a partnership or corporation. Number 5, there must be a true business purpose for the rental. Okay, and we talked about whether it's business meetings, planning, strategy sessions, masterminds, some sort of marketing, etc. Next, there must be a substantiation of the business relationship. And so what is there? What is the documentation that should be in place? Number 7, a 1099 should be issued unless it's under an accountable plan. And then lastly, you can use this rule. Number 8, you can use this rule for employees, shareholder employees, or employees of a corporation or an entity if covered under an accountable plan. Once again, this is Josh Belk with the Belk on Business podcast. Hopefully this particular podcast brought you some value. We'll be talking here in the coming weeks about some other tax helps as we approach the end of 2024 that you may be able to implement inside of your business to save you a few dollars. Hope you have a wonderful day.